Welcome to our next video on auditing, specifically the topic of the different types of audit opinions. So once we have completed an audit, we've done all of our testing, we're ready to communicate the information to the users through an audit report. Now there are a variety of things when we get into the audit report itself that we'll actually be communicating. The opinion is the main thing they're looking for. So yes, they're going to see the financial statements, but the audit report has the opinion itself. So the investors want to know, can they rely on those financial statements? Do we believe there are material misstatements or not? I want to mention that there are 5 basic potential results of an audit. Now, the first one is the vast majority of audits. It's going to be considered unqualified. Now, at first glance, that seems odd. It seems like a bad term. But what we'll actually see is that that's actually the best audit you're going to get. It's a clean opinion. So let me clarify the idea of qualified versus unqualified. Now, if you think about a physician, if you're going to your doctor, you certainly want to see a qualified physician. You want your physician to be qualified, to do the best work. And we're saying the same thing about the auditor. The auditor themselves that's doing this review needs to be qualified. So they need to have the qualifications to do the job, the training, the expertise, all of that. But the opinion itself, we want to be unqualified. So what does that mean? The idea of a qualification is that it's something outside of the norm. So something unusual about it, some exception. The idea of a qualification is an exception. Now, for things that require expertise, or in other words, a physician or an attorney or a CPA, the idea of the exception is that they're above and beyond the average. That's the exception. They've taken all these courses, they've got a degree, they've got a certification. They're exceptional for that purpose. So that's good for them, but for an opinion, we don't want something to be outside of the norm. We want it to be what we expect. We want it to be the expected result. So that's unqualified. There are no exceptions to it. The idea here is that we're saying these statements we believe are fairly presented in accordance with GAAP. No ifs, ands, and buts. So no exception. Nothing that would lead us to believe otherwise. So that's an unqualified opinion or a clean opinion. The qualified opinion, on the other hand, is that, well, most things were in accordance with GAAP except for these few things we found to be in error. So a qualified opinion, we're going to see, means that there's something wrong, but it's not necessarily huge. Adverse is the worst. It's the worst of these 3 at least. That means that there are pervasive errors that have been found in the financial statements, and we cannot give a clean opinion. We believe there are major errors you need to consider when determining whether to trust these financial statements, and we'll explain why. So those are the 3 main ones. A disclaimer of opinion is actually no opinion at all. In fact, the auditor is saying, due to some sort of scope limitation, we are not able to give an opinion. We don't have the information available. We weren't able to test certain things. Maybe management themselves has limited our access to information, and therefore we can't provide an opinion. That's generally bad news, but there might be a valid reason for it. But generally speaking, a disclaimer of opinion, you have to realize that the auditor can't give you any assurance. So you're relying completely on what management has provided. But depending on the reason for that disclaimer, that might be a red flag, especially if it dealt with a scope limitation, that the auditor wasn't given access to the information they needed. The question then is why? What was management trying to hide? Now, there's actually a 5th result, and it's even worse than a disclaimer of opinion. This is a withdrawal from the audit. So at least with a disclaimer of opinion, the auditor is saying, we've completed everything we're going to complete. We stuck with it to the end, but we couldn't provide an opinion because of some scope limitations. A withdrawal from the audit is the auditor themselves saying, we no longer want to be involved with this company. we don't want our name associated with this company. That is generally very bad news. When they withdraw from the audit, they haven't even completed the audit. I mean, that's their work, so they're going to try to do what they can. But if they've uncovered fraud, or if they have a very significant scope limitation, or maybe they've lost their independence, that'd be a valid reason for withdrawing from the audit, that they've just lost independence. Maybe they found out that their auditors were actually somehow related to the company. So then they would withdraw from the audit. No audits completed whatsoever. And you can't place any reliance on those financial statements. So that's a high-level overview. We'll see some more of that in just a bit. The opinion overall is an opinion on whether financial statements are free from material misstatements. And we're talking in accordance with GAAP, the generally accepted accounting principles. So are they free from material misstatements when following those GAAP requirements? There might be situations where GAAP requires one thing, but due to the special circumstances of that industry, following GAAP might actually be misleading. So that company, based on some other permission, so to speak, might be following a non-GAAP approved method. It's still in violation of GAAP, so it's still considered a material misstatement, but there might be a reason for it that can be explained away. Again, we're only providing reasonable assurance as an auditor, so it's not a guarantee that there are no mistakes. It's not even a guarantee that there are no big mistakes. It's just reasonable assurance. But the other thing is that we're focused only on material misstatements, so we're not providing any assurance whatsoever as to whether there are any immaterial misstatements. In other words, we don't care if there are small mistakes that wouldn't change anybody's mind anyways. We're not even bothering to look for those. We're looking for the big material misstatements. And as I've said before, this opinion is not any sort of comment on whether the company is a good investment prospect. It's just an opinion on whether you might be able to rely on this information to make your own decision about the investment prospect. Auditing standards now require that when the auditor is doing their financial statement audit, they also have to provide an opinion on the effectiveness of the internal controls. And this started out with Sarbanes-Oxley back in the early part of the century after all of the scandals from that time. This is separate from the opinion on the financial statement accuracy, but it's very important because you want to know, does this company have a strong set of internal controls that would help to detect and prevent any sort of fraud or misleading information from coming through? So now we're going back to the high level and looking at the overall audit report. Some of the components we have there would be a title, an addressee, the opinion itself. That's the key thing we're talking about here. The basis for the opinion, in other words, a responsibility statement, who's responsible for the financial statements, that would be management, and who's responsible for the opinion, that would be the auditor. We have a statement that it's conducted in accordance with GAS, generally accepted auditing standards, if it's a non-public company. If it's a publicly traded company, it would be in accordance with the PCAOB, Public Company Accounting Oversight Board. Now, of course, if we're talking international, there would be international accounting and auditing standards, but we're focusing here on the United States standards. And then there's a paragraph talking about the scope of an audit and some of the limitations to that scope, what we're really looking for. There might be explanatory language if it's needed. And, of course, there'll be a signature so you know who prepared this audit report. So some of what we're seeing now is what I talked about initially. The unqualified report is a clean report. That's the best one you can get. There are no exceptions, no major exceptions from the standards to note. But I do want to mention something here. Even though it's a clean report or an unqualified report, that means that there are no material misstatements to note. But it might still have a slight modification. You might have some explanatory paragraphs. It's just some things you've noted, but they're not worth qualifying the report for. In other words, don't be too concerned about this, but we found something we want to bring to your attention, just so you're aware of it. Again, it doesn't have to be bad. It's just an explanation. It's the auditor's judgment as to whether those extra things rise to the level of needing a qualified or possibly adverse opinion. Now, for an unqualified report, the order of the paragraphs, now, by the way, depending on if you've looked at auditing requirements before, if you've looked at financial statement audits before, this changed 12/15/2017 with fiscal year ends after that, on or after that. The order of the paragraphs is different. The design of the paragraphs is different than it used to be. We have the opinion statement, the basis for that opinion, and then any critical matters that might need to be discussed. So that's the order of the paragraphs there. So let's go through an example of that. And I'm just going to read this word for word because this is an example of how it would look. And I do want to mention here that if you have 10 different companies prepared by 10 different audit firms, but they all have the same clean, unqualified opinion, they're all going to look virtually identical to this. There's not a whole lot of room for movement between an auditor or between a CPA firm and what they use, how they word this. The consistency is important so investors and others can know what really does this mean. So again, I'll read through this. We have audited the accompanying balance sheets of Severson Company, the company, as of 12/31/2019, the income statement, statement of stockholders' equity, balance sheet, and statement of cash flows for each of the 3 years in the period ended December 31st, 2019, and the related notes and schedules, collectively referred to as the financial statements. That bold underlined sentence I have next is the key verbiage. In our opinion, the financial statements present fairly. That's an unqualified opinion. That means there are no major issues. So present fairly in all material respects the financial position of the company as of 12/31/19 and all of that in conformity with PCAOB standards. Now, the basis for the opinion. These financial statements are the responsibility of the company's management. Our responsibility is to express an opinion on the company's financial statement based on our audits. We are a public accounting firm registered with the PCAOB and are required to be independent with respect to the company in accordance with the U.S. federal securities laws and the applicable rules and regulations of the SEC and the PCAOB. So that's what's talking about the responsibility, all of that, the basis for opinion. The next one is essentially your scope paragraph. We conducted our audits in accordance with the standards of the PCAOB, and it goes through all the requirements of those standards, what our audits include, and our audits are also include evaluating the accounting principles used and the significant estimates made by management. And the final sentence here, we believe that our audits provide a reasonable basis for our opinion. So that's the unqualified report. Again, no matter which company you look at, if they have an unqualified report, it's going to look very similar to that. The qualified report means that there's something wrong, but it's not necessarily pervasive. It's something we need to call to your attention. We believe there are some material misstatements, but they may not be horrible. They may just be somewhat limited. So an audit report might be qualified for multiple reasons. There might have been some somewhat immaterial, I don't want to say immaterial, some lower level scope limitations that hurt the fact we couldn't review everything. So it's not so bad to cause a disclaimer of opinion. There are just little pieces that we weren't able to review, so that qualifies it. There might have been a departure from GAAP, so they used a different method that's not allowed by GAAP, but we don't believe it's pervasive. We don't believe it's super material. And there might have been inadequate disclosure. So yes, the numbers look all right, but the company did not fully disclose something that investors might need to see about that financial statement. Again, if it's material, but it's not a pervasive concern, it might just be a qualified report. But if it is pervasive, in other words, the same types of errors are found all the way through the financial statements, or if it's just a very material item, then the report's generally going to fall to an adverse opinion, which is much worse, basically saying we don't think you can trust these financial statements. Qualified isn't the worst thing in the world. Let's put it that way. So the order of paragraphs, very similar. Opinion, basis for opinion, but the next piece is the discussion of the qualification. In other words, we gave a qualified opinion. Why did we qualify it? And then, of course, there are going to be the critical audit matters that might need to be brought up in that audit report. So I'm not going to read through this whole thing for the opinion, but what I want to point out is the bold verbiage. In our opinion, except for the change in accounting principle discussed in the following paragraph, the financial statements present fairly. So the point is they give you the opinion first, and then they explicitly state that we'll give you more detail in the next paragraph. So right away it catches your eye. There's something to look at, and then you can go look at it. Opinion part 2, now they talk about that reason for qualification. Here, as disclosed in Note 10 to the financial statements, the company adopted in 2019 the FIFO method of accounting for its inventories, whereas it previously used the LIFO method. Although the use of the FIFO method is in conformity with the United States accounting principles, in our opinion, the company has not provided reasonable justification that this accounting principle is preferable as required by those principles. So going back to the consistency principle of accounting in general, it basically says, yeah, they can change methods, but they have to have a good reason. They have to have a justification for it. And if they do so, then it requires a lot of extra disclosure as to what the information would have been had they never changed, had they always used this new method. But the key point they're calling out here is that they have to provide justification for why they're changing in the first place. And in this case, they didn't. So now the adverse report. The order is basically the same, the opinion, the basis for opinion, and the discussion of, really this would be more like the discussion of why it's adverse. What major issues did you find? It's still a qualification, it's just a very high level qualification. And again, critical audit matters. So the adverse report. I'm going to read the bold again. In our opinion, because of the effects of the matters discussed in the following paragraphs, the financial statements do not present fairly. So let me jump back to the qualified report where it said, in our opinion, except for the change in accounting principle, the financial statements do present fairly. So it still believes they're fair with a qualified report. With an adverse report, it does not believe they're fair. The financial statements do not present fairly. That's the difference. That's the main difference there. So the reason for this one, as discussed in Note 10 of the financial statements, the company carries its property, plant, and equipment at appraisal values, in other words, fair market value, and provides depreciation. And then there's another reason here, but then it says accounting principles in the United States require that property, plant, and equipment be stated an amount not in excess of cost. In other words, you can't update to fair market value in the United States at this point, and this company did, so it's improper. That's what we're saying. They're not fairly presented in accordance with GAAP. They're not following the rules, and it's probably a very material item. And here they go into detail on some of the dollar amounts, what the impact of those errors might be. So this is a lot more mechanical. There'd be a lot of detailed work behind this. The next one we're going into is the disclaimer of opinion. So this is where, for whatever reason, we could not provide an opinion. So this one I will read through most of the way. We were engaged to audit the accompanying balance sheets and the related statements. You can give all the different titles of those statements. As described in the following paragraph, because the company did not take physical inventories and we were not able to apply other auditing procedures to satisfy ourselves as to inventory quantities and the cost of property and equipment. We were not able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion on the financial statements, and we do not express an opinion on those financial statements. So we have a pretty severe scope limitation. We can't give an opinion on whether those are right or wrong. We can't say they're bad. We can't say they're good. We just can't say anything. So we're disclaiming an opinion. Here is more of an explanation. These dollar amounts, again, we just can't provide any sort of opinion on. We have no way of auditing them. The basis for the disclaimer of opinion, again, this is telling us what rules we have to follow as auditors. Same thing as before. And the withdrawal from the audit is the worst. Now, generally, you're not going to have an actual opinion. You're not going to have an audit report because this auditor did not make it all the way through. They couldn't for whatever reason. So some of the reasons you might withdraw from an audit is the discovery of fraud. And what I'll mention with the discovery of fraud is that audit firm, the very first thing you're going to do as soon as you discover fraud is involve your legal counsel, your attorneys. Obviously, those attorneys should have experience in the industry of audit. So that'd be the first thing. But if you discover fraud, if you have an independence impairment or a loss of objectivity, again, it's not the worst thing in the world. That you're not saying anything is bad or wrong there. It's completely different than if there was fraud. If you find out after the fact, which is unfortunate, by the way, because any independence impairment should be identified during the planning stage to begin with, to make sure either we don't engage with that company to begin with, or we hire a different auditor. Maybe it's just one auditor that has an independence issue, so we hire a different team or a different auditor, and that's fine. But if you do at the end find you have an independence impairment or a loss of objectivity for whatever reason, you can't continue with the audit. It's not a bad thing on either party, you just can't continue. You would not be independent, your information would be worthless. You might have significant scope limitations that are far worse than the one we discussed with the disclaimer of opinion. If management is just flat out not allowing you to test anything, you don't know for sure whether there's fraud yet, but it might be a red flag. It's different than the discovery of fraud, but it's kind of along the same lines. You can't test, you can't do any work. Why bother even trying to complete it? Continue. There might also be, by the way, major disagreements between the auditor or the audit firm and the client. In those situations, a withdrawal from the audit, it's kind of, again, the scope limitation. It might just be best to withdraw. In that situation, that client, that company that you're auditing, has to go find another auditor. They have to have an audit to present those financial statements. Otherwise, they're in violation of SEC requirements. So if they're unable to work with you to complete the audit, they're going to be in a bad position because some time has probably already run out. They have a deadline to get those financial statements issued. They don't have all the time in the world to do it. So if they've already used up a month on one audit firm and they're pushing back, they're not giving them access, they're going to run into issues. So they're causing themselves some concerns. So that takes us through the discussion of the various types of opinions, the types of audit reports. Hopefully this has helped to clarify some of that information. But if you have any questions, please let me know. I thank you for your time, and I will talk to you in the later lectures.